Everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking about the Bank of Canada, their 0.5% increase that's coming in April, and what that could mean for you as a Canadian and as a consumer and a home buyer. So stay tuned, we're going to dive right in. If you're watching this video on the Team Sessa Real Estate YouTube channel, I'd like to start off by saying that I'm happy to be here and happy to extend the video content for financing on this segment called Finance Fridays, as we're going to try to bring you fresh, new, and exciting content, whether you're an existing homeowner, a first-time home buyer, a real estate investor, everything for mortgages and real estate, and everything in between. Our goal is to make sure that you have all the information you need to make a sound financial decision when it comes to real estate. Now, if you'd like to leave a comment, suggestion, or question, feel free to do that in the comment section below. We'll be happy to hear from each and every one of you. We want to know exactly what you're thinking, and we can help design future topics around your comments. While you're down there, please don't forget to hit the like, subscribe, and notification bell so you can get notified when fresh new content is posted. And while you're down there, if you want to book a consultation with Santo or myself, feel free to click in the description box, click on the calendar, and set up an appointment. Now, back to the video. Once again, thank you again for tuning in to Finance Fridays. Hope you are all enjoying the content that we're producing. But what I wanted to do is start off this topic with a actual real life phone call that we got this week and sort of something that happened. What we did was we had a client call us that we had done a pre-approval for back in December, and they were looking to go out there and purchase a home. Obviously, the markets were very, very hot in January and February with lower inventories. So the pre-approval is about to approach its expiry, and basically the rate that we had secured for this client was very aggressive, very good rate, non-existent now in this current marketplace. But basically the client was concerned that they had a very short time frame left in order to secure a purchase and close the transaction in order for them to maintain the rate that they were quoted on the rate hold. So basically what we said to the client was, look, the best advice that we can give you at the current moment is that we reapply with a different lender to securitize a different rate, obviously what is happening right now, but with the potential that rates can go up further, at least you're hedging on the fact that you'll have a lower rate when you can close the transaction, because meeting the seller's demand and closing guidelines and trying to make sure that you get the most aggressive rate often doesn't align in a perfect world, only in a perfect world, I should say. And if you're able to close the transaction in the time frame, then hey, you get the better rate. If you don't, unfortunately, you will have a higher rate. But if we look back, everything's 20/20 hindsight. We may have been able to aggressively lock in a much better rate than what's happening now. Fixed rates, as I mentioned, are on the surge. We're getting a lot of phone calls from our lenders over the last few weeks saying, hey, be advised, rates are going up, and they've surged anywhere from 40 to 50 basis points with most lenders, depending if it's an insured or conventional deal. But we're going to talk about the Bank of Canada and basically what that means and what to anticipate moving forward in case you haven't heard. So I'm going to dive right into the first article. So this article here basically headlined, Bank of Canada prepares to aggressively tackle inflation. Obviously, this is something that is important. And, as we go through the conversation, it's important to understand that Deputy Governor Kozicki has aggressively basically made the assertion that they are going to, as a central bank, tackle inflation and bring it back down to 2%. So they're trying to harness what's happening geopolitically, what's happening in the world, and trying to make basically lives a little bit more affordable in Canada. And as I mentioned earlier on in the video, the ways that they tackle inflation is by increasing interest rates. And this is why they're throwing out the concept for 0.5% increase. Basically, you'll see this tweet here. It says the even effect of the pandemic made it all the more urgent to understand how differences amongst households matter for the economy, the financial system, and monetary policy, Deputy Governor Sharon Kozicki explains. So what I wanted to basically stress here is that, as I mentioned, they are throwing out the idea of a 0.5% increase. their rhetoric, the words that they're using, unwavering, forcefully. These things are very important indicators for economists and banks to look at how the Bank of Canada is thinking in the back of their head and what to expect moving forward as the markets, whether it be the stock markets, all the types of markets are going to price in what they're saying, right? Whatever the Bank of Canada and central banks say has resonance in other markets or other parts of the market, I should say. So here in the quote, you actually see a little bit of her talking about how different households get impacted by different monetary policies and how these policies can impact the average household. Now, one important distinction to understand is that in her speech or in her webcast that she was talking about looking at average households and how an increase to the overnight policy rate or 0.5% increase can impact many Canadians. And obviously it's important to understand that. So the Bank of Canada does have a job to also tackle inflation, but they also need to make sure that as a central bank, they do not send the entire country into a recession, as that is not their goal. But obviously we know central banks will tend to overreach and then have to pull back if they are aggressive, or too aggressive, I should say. They move the needle too hard, too fast. But I digress. Going back to the housing, they look at the mortgage indebtedness, they look at the debt loads for Canadians, they look at fixed, variable. We know here in the mortgage industry, 60% of new mortgage origination has been on the variable end, and the Bank of Canada knows this as well. So they are seeing that many Canadians who over-levered purchased larger homes, taking on larger mortgages. Obviously, the savings impact of that, because there was a huge amount of savings over the pandemic era where we saw many households basically able to save money. The Bank of Canada also indicated that many people took advantage of prepayment privileges. They were paying down their mortgages, paying out their consumer debts, or paying down their consumer debts, as well as, they were taking advantage of, the lower interest rates that were happening, right? Because during that time frame, we saw interest rates hit, the effective lower bound on a variable end was at 0.25%. We saw variable rates sitting at around, 1.2, 0.99%, and then we saw fixed rates at 1.4, 1.5. So many Canadians who were able to restructure, refinance, and maybe get into a lower rate mortgage, they took advantage of that, and they're not having to worry about that for the next 5 years. What the Bank of Canada is also indicating is that they're more concerned with, newer home purchases, newer home buyers, people, young couples, employment, and servicing those debts, as that is a major cause for alarm also for the Bank of Canada. Now, another thing that we should consider with the Bank of Canada and their thought process, as I mentioned, is once they throw out this concept, what's going to happen, how the banks are reacting. So banks are pricing in these increases as well. The markets are pricing in these increases as well. So that's an important indicator to see exactly what happens moving forward in the next couple of weeks as we approach it. So it's too early to really make a prediction on where the Bank of Canada is going to go. Most of the markets were pricing in a 0.25% increase in April. Now they're throwing out a 0.5% increase. We'll need to see how that happens. But what I would like to juxtapose that to is what's happening in the US. And Jerome Powell at the Federal Reserve, they've also indicated a 0.5% increase. So there is some, alignment happening with central banks. But the job of central bankers is to make sure that they move in lockstep or in some form of coalition, so that they can basically avoid any catastrophes or global financial crisis, much like one we saw in 2008. Speaking of interest rates, this is a little chart that I pulled up here, and I wanted to address the concern for many Canadians who are a little bit alarmed with it, especially younger Canadians. I think that's an important distinction. Many older Canadians or people that have been in the housing market for some time now, who maybe had a variable rate mortgage, who've lived through some of the higher interest rates. It's not too long ago that we saw interest rates, or the bank policy rate at 1.75%. It was just basically this 2-year window here where we saw interest rates drop to the effective lower bound, and we were, good rates, good low rates for a long time. That's basically what the Bank of Canada, Tiff Macklem, will come out back in March, April of 2020, indicating to Canadians. But if we look back to 2018, we did see rates at 1.75%, which translated to, off the top of my head, our fixed rates were around, I believe, 3.5%, 3.4%, and variables were in and around the same thing. I think they were in unison for a short window of time back in this period. Don't quote me on it. I would, if I'm wrong, please let me know in the comments. Let me know what rates were in 2017, 2018. But basically, that was something that we saw. Here's another supporting article that I encourage many of you to go out there and look around and see exactly. It says Bank of Canada says it's ready to act forcefully to meet the 2% inflation target. Obviously, just reinforcing a lot of the sentiments that we're going to see out there in the marketplace moving forward as we approach April 13th when the rate announcement happens, and basically the unwavering support from the central banks to address inflation. That is very, very important. And when we take all this information together, it's very, very important to understand, we have inflation at 5.7%. It's the highest it's been for the last 30 years. And there is something here that we do need to address. And for an economy, and this is me, this is an opinion, it's a thought, as a country, as an economy, interest rates, when they go up, should be in a time frame when the country and the economy can support it. Obviously, we've seen employment come back down to the unemployment, come back down to pre-pandemic levels. We have seen some growth. Obviously, we are still facing a high debt load due to the stimulus, all the money, quantitative easing, all the money printing that happened. Obviously, as a country, insolvency is a major concern. All these things are taken into consideration by the Bank of Canada. When I look at my opinion of what has to happen here, obviously, it is important for us to look at the average Canadian and how these changes can impact them. Now, with that being said, if you're looking at it going, okay, inflation, oh my God, 0.5% increase, this is devastation, what can this do? Obviously, we have to look at wage growth. We have to look at, the Bank of Canada is doing their data research to see exactly if the economy can hold. Speaking to some investment advisors and some economists in our field that I have arm's length reach to, talking to them, basically they're indicating that interest rates that go up gradually over time and that basically can be absorbed over time are definitely a good thing for the economy because it means the economy is performing well. However, if they overreach and we start to see that these interest rate hikes start to have the negative impact, we could see the country go into a recession, or we could see some markets hit a recession. Now, obviously, Canada is heavily dependent on housing. Housing as a sector, housing as an asset class. Real estate is basically a huge proponent of the Canadian wealth. And agree or disagree with that comment, it is something that 68% of Canadians own homes. And I think the last time I looked at some of the data points on that, it was like 40% of them are mortgage free. So when you're looking at the entire picture of Canada, who are these increases going to hit? Are they going to hit people that don't have a mortgage? Are they going to hit people that have lines of credit? Are they people that have consumer debt? As far as interest rates when it comes to real estate, this is something that we need to digest a little bit more and sort of have an outlook on it. I don't like giving predictions on how interest rates can impact a housing market, but obviously, we do know that there are some ramifications when interest rates rise on housing because affordability changes, not to mention the qualification of the person going to purchase that home. Because if you're using a fixed rate mortgage of, let's say, 3.8%, now basically that is the posted rate or the discount rate that you're getting, then plus 2% means you're qualifying at 5.8% as opposed to 5.25%, which is the general qualifying rate because rates were significantly lower. So will that push more people into a variable rate mortgage? Because basically if that variable rate mortgage is below the 5.25 threshold, you get to qualify at that rate, or are you going to qualify at the fixed rate? These are some things that we need to understand. As I mentioned from my client earlier on, all these pre-approvals that are out there that are maybe coming due to expiry, or maybe people that have renewed them into a better rate, once those fall off, what will happen to the real estate market? Are house prices going to hold steady? Are they going to go flat? I know there's a lot of data on there, and I will cover this topic a little bit more in depth in another video, but I just wanted to leave these thoughts as we embark forward onto April 13th and things that you should be considering. Personally, as I said, with what's happening right now, I think as a mortgage broker, even real estate and professionals, it's very difficult to have a long-term view. Obviously, predictions are very difficult, and very small percentage of people who make predictions actually are correct. So, obviously there's external factors here at play. Obviously, anything in the world right now, what's happening with Russia and Ukraine, obviously that was something that we didn't see coming, and that definitely has a further impact when it comes to cost of goods and how that's further, exasperating, inflation and pushing prices up. So we'll leave the video there. I do want to hear from you if you have any comments, feedbacks, or suggestions about the Bank of Canada. What are your thoughts? Do you think they're going to increase 0.5%? You think they're going to only do 0.25%? Let me know in the comments below what you think, and we'd be happy to have a discussion about it. But we're going to leave it here. I hope everyone had a great experience with this video, and if you did, remember, please like, share, subscribe. If you know someone that would benefit from this content, please feel free to share that with them. But we'll leave it here. I wish everyone a great Friday and an even better weekend ahead. Thanks for tuning in. Until next week, have a great one.